Hello and welcome to today's episode. So, what we're actually going to be talking about is why the stock market is set to boom. So, these are just my reasons why I believe that the market is going to be doing big things for the remainder of this year and also into next year and the future beyond. So, you want to get out your notebooks, get out your notepads, anything that you use to take notes, and just join me for on the ride for this episode. So the first reason is actually low interest rate environment. So if you're new to the channel, welcome. So what we've actually been doing over the last few weeks is talking a lot about the interest rate, and this is because the government or the Fed actually lowered interest rates for the first time in September 2024 since the COVID-19 pandemic, and this is a huge deal. And so with low interest rates, so once interest rates are low, usually the stock market actually starts performing much better. And so far the stock market year to date this year has actually outperformed all of last year's entire 12-month run so far. And so the reason why interest rates actually, once interest rates starts to lower, it really starts to boost the stock market in particular, is that interest rates really cover are just the cost of borrowing. So if you are looking to purchase a motor vehicle or a mortgage or just cover personal expenses, and so you take out a personal loan during high interest rate periods, you actually end up spending a lot more just to service these loans rather than if you had taken out these interest rates in a low interest rate environment. And this is because when interest rates are lower, the cost to actually service these loans is a little cheaper. And so if you are working and you, let's say you earn 3,000 US dollars a month, and so now you decide that you want to actually take out a mortgage, and the mortgage right now in a high interest rate environment costs you 1,500 US. That's 50% of your investment that's gone automatically. And and so with interest rates in a lower interest rate environment, now that same mortgage would probably have cost you about 1,200 US dollars, and so you would have been able to have $300 additional disposable income. And so the more you have as disposable income is actually the more that you are able to spend. And if you have more funds available to spend, then you naturally have more funds available to invest. And so the more funds that you have available to invest really would just trickle down across the entire financial environment, the entire financial system. And so this would then change and cause persons to really have the amount of funds able to invest or not invest. And so with actual interest rates being high, when interest rates are high, it really means that more persons tend to save, and this is because the actual banks would be paying more on the deposits when interest rates are high rather than when interest rates are low. And so this really ties into the next topic, which would be the CPI or the inflation rate. So the inflation rate really just tracks the cost of an actual, just the cost of the goods or services over a period, so a previous month, previous year. And so the CPI actually measures a basket of goods, and it tells for these different types of services and goods the price changes over month and year over year. And so since the COVID-19 pandemic, these baskets of goods actually increased, and so it reached levels that were not seen for a very long time, seeing some figures being as high, double figures as high as 15%, 10%, and these were for individual items that were being increased over time. And so what this means was that as food items, as clothing, as expenses, as entertainment, as going out all cost more, then persons would have less disposable income, and so less disposable income would mean less money to invest in the markets. And so this now ties back to our next topic, which is the commercial versus investment banking. So investment banks tend to invest based on opportunities and where they see the best opportunities. And so when interest rates are low, then the investment banks would invest in the stock market, and investment banks would consider your asset management companies, your pension funds, the stockbrokers account, those companies, and so forth. And so what really happens is that as interest rates starts to rise, they then start moving their funds from these very volatile assets and into less volatile assets. So they would start targeting assets such as the corporate and government bonds, your money market instruments, so that would include your treasury bills, your treasury bonds, your certificates of deposit, your repurchase agreements, and so forth. And so as these assets start seeming more attractive, then persons, investment banks in particular, would start moving their funds from these types of these riskier assets, which is the stocks, and into the more longer term, more attractive assets, so the bonds and money market funds. And so as that change starts happening, then the volume would actually start decreasing in the stock market, and so with that the volatility increases. And during high interest rate periods, consumers tend to gravitate towards safer assets as they tend to produce much better returns than the actual volatile ones. And the reason for this is that with the stock markets, the during low interest rates and high growth periods, then new projects, new companies that come out would actually have a lot of potential, and so they will have a lot of energy, attractiveness behind them. Persons would be behind them, investing, and as they invest, then the company would start seeing growth, and a lot of exponential growth would be happening. And so with the interest rates and the economy shifting from this highly confident to and greed economy to a more fearful economy, where persons are now fearful as to what is actually happening and what will be happening going forward, then they also would be shifting their money from these high into lower and safer assets. And so these highly growth projects would now start actually seeing a decline in their growth, and so those exponential growth that you would have been seeing during these high economic times would now start lowering, and they start slowing down. And so your capital would actually also be at much greater risk. And so with that, persons tend to really move away from these higher volatile assets into these safer, less speculative types of assets, which really is just the flow of money. So how money really flows is that the money people tend to follow the money, and people tend to invest where they make the most money and they see the most opportunity. And so if the stock market is booming and it's very attractive, then a lot more persons will gravitate towards it. And if the bond market and the money market instruments are actually seeming more attractive and they have a lot more activities in it, then the money would likely shift from the stock markets into these money market and bond instruments, and so these would become more attractive while the stock markets would be less attractive. And so with that, the money would really flow in, and also the commercial banks would gain a lot more funds as well too during high interest rate periods, because with high interest rates persons tend to save more, especially in high yielding savings account. And so if you are now guaranteed 2 to 3% on your investment, if you take a fixed deposit investment and you're guaranteed 2 to 3% on it, and rather than 1% or less, then actually as a consumer and as a saver you would gravitate towards these types of assets also. And so that really is how the commercial banks play a part in these high interest rates environment. And so we'd like to look at the politics, and not to dwell too much on this or dive too deep into the politics, but politics really plays a major and an important factor in any economy, financial and otherwise. And so with politics, so with economies that have high political, that has a high political climate, and by high political climate I mean if the political parties change, then the environment also shifts as well. So there's a lot more protest and more civil war that can break out. Then international investors will be less likely to invest into these types of markets. And if the political climate is relatively safe and stable, so regardless of who wins or loses an election or which party wins or loses, then international investors would tend to be a lot more secure and safe in investing their funds into this jurisdiction. And so right now the political environment in the United States, there's an election happening in a few days, and this is playing a major part into the actual election and the market. And so as I was on social media recently, on Instagram in particular, there was actually videos uploaded by Bloomberg and Yahoo Finance where they both had interviewed respectable and knowledgeable, well-known persons within their fields, and they both had the same synopsis as to what is happening. And what they shared, that the market had priced in a particular person to win, so they are more favored to win within the market. And so the price in the stock market has actually started reflecting this. And also what this really means is not to say that if the opposite party wins that the market will start declining, but it just means that the market feels a little bit more secure and safe with leaning towards one person winning over the other. And they both had shared within the videos that they were unsure who will win because the polls are not really adequate to use, as they don't think it gives a true reflection as to what really is happening within the United States and what's happening on the ground. And so at this point in time, they both had shared that it's really 50-50 in their eyes as to which person will be the new president of the United States. And so historically speaking, what this usually means is that one political party usually tends to favor investments and persons of the higher society and with a higher source of wealth and income over another particular political party. And as I said, I don't want to dwell too much into it. So as we go closer to the end of the year and as we go closer to these elections, then the markets will really start be reflecting what really is happening in the United States. And so any real shift in the political climate within the United States or any last minute changes in policies or political leaders can really influence the stock price at this point in time because of the intensity and so much that's happening behind it. And so the next thing I want to look at is leveraging, and more so corporates versus retail leveraging. And if you're unfamiliar, then leveraging really is just debt. And so with corporates tend to borrow a lot of money. And during low income periods, interest rate periods, corporates would be borrowing a lot of money to expand and to grow their businesses. And especially for those that are in the investment aspect, arm and in trading, and so asset management, portfolio management types of companies, they also would undertake a lot more in terms of debt that they would have within their books. And so with low interest rate periods, they tend to borrow more and invest within the stock market as the markets would be booming. And during high interest rate periods, then the investors would actually be borrowing less. And so also with retailers, a lot of retailers out there tend to follow these corporate strategies in terms of borrowing to really grow their investment. So a lot of persons would borrow and use that money to invest within the stock market, and then they just repay that funds back out of their regular income that they'll be earning on a month over month basis or a week over week basis. And so this really would allow for you to boost your economic investment and your assets. And just a tip and of others, if you are actually using leverage, then ensure that the assets that you are investing in are actually has the potential to pay more than the inflation rate. And so what that really is saying is that if unforeseen expenses come up or something comes up that you had not planned for and you have to sell the assets, then you want to ensure that you're selling less of the units of stocks to actually fund this loan. And so ensure that you do your due diligence, you do your necessary research, and then when you are ready, you invest. You can see borrowing and invest that into the stock market, and then you can really ignite that pace that you would have in terms of investing. And as we actually come closer to the video I want to end, I want to look at Maslow's hierarchy of needs. So Maslow actually, which will be our next topic, so Maslow's hierarchy of needs, and it states that Maslow's hierarchy of needs states that persons have actual wants versus needs. And so as individuals, there are certain basic needs that we have to fulfill first, and then once those basic needs are fulfilled, then we move over to fulfilling our wants. And so the basic needs would be food, shelter, water, and then your income that you'd be getting, and then your relationship, and so forth, self development, personal development, and self actualization, and so forth. And this I can personally relate to this. So I remember when I was actually working and I did my regular 9 to 5, and I had a certain income that I would look forward to every month. And so I had a lifestyle where I would actually try new restaurants as they come out and new foods and cuisines, and I'd also be have a certain style and an image that I would have maintained, and so I'd spend and invest in my style and my just outlook and my image. And and then the next thing I actually remembered when I had lost my job, and the next thing I realized that there was an automatic switch in my mind subconsciously, and instead of going out and meeting with friends and trying different cuisines and restaurants and keeping up my image, it was my mindset had now shifted into a survival mode basis. And so what that meant was that I had to just think about how am I going to have the funds that I have now in my account or in my investments. How is it going to serve me over the next few days, the next few weeks, the next few months, possibly the next few years? And so that was my mind shift, and I immediately had to cut off so much different expenses, and I just kept the basics. So just the basic needs that I had to actually keep, and that's what I had spent on. And so investing became almost stagnant for a period of time. And then once I was able to actually regain my income again, I realized that I had moved now from the survival mode into this whole self development, personal self actualization, personal image style of outlook on life. And so I actually was now able to view the world through a different lens, coming from an instance and a case where I had zero income, and I had to just figure out how I was going to get by each day, each month, each week, and now to actually having that sense of security again and that income coming in again. And now I was, I'd say, much smarter and wiser, and I'd focused since then much more in terms of my investments, as I want to ensure that if something like that should happen again, I want to ensure that my investments can cover my lifestyle. And even if it would be a slight decline in a month to month asset and cash that I would have, I want to ensure that I have a certain level that I can expect over month basis. So whether it's dividends being paid quarterly and I just use it each month, I want to ensure that there's a certain level that I have. And so I have now been looking at this world through a different lens and a different eyes. And this but rap really just brings in our last topic that I'd like to look at very nicely, and that is wants versus desires. Now, if you're a person that you want to invest in the stock market, then you're going to do just that. You're going to invest in the stock market, and your investments are going to be just maybe a few dollars, maybe a few $100, and that will be it. So you won't really have much of a plan investing, and you just be putting money in every now and then and it wouldn't really be a plan that you have and an investment strategy that you'll be going with. And when I just started investing, I too was very guilty of this, as I wanted to invest in the markets, and I did just that. I invested my funds every now and then in the market, but it wasn't really consistent. And when I say consistent, I mean every month kind of thing. It was more like today I'd invest, and then I wouldn't put any funds in the market for a while, and then when I remember, I'd invest again, and so on. And that's how I built my assets initially. And however, as my desires changed, and now I started setting my goals. And this is a very important tip to do. So want if you desire something, write it down. Get a piece of paper, post it stamp, a dream board, whatever, and put goals at the top of it, and write down each and everything that you want. And then now, as you have those desires, then those desires will ignite a flame within you and start a spark. And so that spark will now be what was going to fuel you into getting what you want. And so if your desire is to have $1 million in the stock market, then you're going to start investing like you want to have $1 million in the stock market. And if your desire is to own a 6 bedroom house, or to drive a nice luxury car, for instance, or to travel, then you are going to start changing how you look at money and how you look at life. And now you're going to start getting that funds to get to do and be able to do what you want to do, whether it's going to be through the stock market, you're going to start another business, whatever you do. But the stock market is really a good tool to use, especially now with interest rates lowering. It's definitely a good time to get into the markets. As interest rates gets lower and lower, then the markets will eventually start booming again, and you want to ensure that you have entered into the markets before that actual growth period and that boom period. And so you want to invest just before that period so that you can fully capitalize on everything that has and will be coming within the markets. So thank you all so much for watching this video. If you like it, I just ask you to give us a thumbs up, leave any comments that you have down below. I will get in touch with you, I will respond to you, and subscribe to this channel so that you don't miss out on any future videos as soon as they are launched. Thank you guys so much. Take care. Bye.